Good afternoon. Thank you for joining us. I'm Bill Knock from Keystone Business Ventures. Today we're here to talk about exit strategy, and we want to first, though, thank our host, Environmental Consultant and Affiliates Network, for allowing us to broadcast from their training conference room. So if you see all of these environmental pieces of equipment on either side, that's what that represents and is part of their training program. Today, though, we're glad that you are able to join us. And as we go through the presentation, you do have the opportunity to forward us questions. They will get a hold of us as we go through the process, and I'll attempt to answer them. Some of the questions, hopefully, are just going to be covered in the presentation itself through normal due course. At any time, if you think of something that we don't cover and you still have an answer, you can always send an email to us and we will respond. At the intermission, I'll post up my email address and make that available to you. And then at the same time, we'll ask you to respond to us because we'd like to forward some additional reading information about the exit planning strategy. All right, with that said, exit planning is often considered part of a master plan. It's considered a master plan because it's not just the strategic planning for the business. It's also strategic planning for you and your personal wealth. The whole concept of the master plan looks into the future of what you will do after you are finished with your business. Once the exit has taken place, what will you do next? The next venture? Someone my age, most people might think it would be retirement, which is possible, but it's also the opportunity maybe to take on a different type of business down the road. In either case, you want to make sure that the resources that you have available would be there. So what we have representing the master plan are three legs of a stool. One that talks about maximizing the company value, the other that talks about understanding what you're going to do next, and to make sure that both of those are allowable, meaning the dollars that you have in your personal wealth, the dollars that you may gain from exiting your business, and the requirements that you have in the future can all be accomplished at that point in time. That creates what we will refer to as a triggering event. That event that says, yes, all systems are go. I've lined up the dollars that I have in my personal wealth. I've lined up the dollars I expect from my business, and I know what I want to do next, and I know what the dollars are needed to make that happen. When all that comes together, that's considered the master plan. We want to talk a little bit about what we hope to cover today. What will you take away out of the presentation? So it's kind of set up in a question format, as if you were asking me. I'm going to talk about those things as we go through, and hopefully they will be answered adequately to your needs. First is, where do you begin? Well, being here is a good place to start. The other things that would make sense is obviously collecting information, articles to read, talking to other business owners, maybe even those that are no longer business owners, and kind of canvassing and understanding what process they went through to accomplish their succession process. In that, were they satisfied? That's also very important. Satisfied in maybe the monetary dollars that they received, but also satisfied in their ability to accomplish what they plan to do next. In that, we also have to understand that the actual physical transfer of ownership, there's a lot of options. Well, what are they? How can I do that? We'll talk about that. Whether that's sale to a third party, transition to family and friends, or to partners, lots of options out there, even to the employees. We'll talk about that a little bit in detail. And then, who do I need to help me get this done? What advisor should I consult with? We'll discuss that as well. The other portion of this is to understand what other individuals besides advisors should be involved. Family, friends, life coaches. There's a myriad of different possibilities out there depending upon your personal needs. That's really what has to be assessed. And the person best able to do that is you. We can work with you and help drive some of that. When do I know when to pull the trigger? Good question. Is it when my business is doing the most in terms of sales and earnings? Or is it when my industry looks like it's going to continue growing for a long, long time? Or is it when the economy is roaring up? When is the right time? Again, it will depend, but we'll discuss some of those issues that you should consider. And then the what if analysis. What happens if something bad happens to me as the business owner? What we'll talk about is called the 5 Ds, and we'll go over those in detail and talk about how we might build contingencies for each of them. How do I ensure people stay when I leave? My employees, the key employees, are the most critical part, the people that help you make your money. They are the ones that would be just as important to whoever follows you in your business. So understanding what that is and having them to become a part of that is something that you should also be looking at. Then there is a certain best business practice to this preparation for ultimately exiting, best business practice for the transfer itself, and then also a best business practice afterwards. In many cases, just because a transaction is complete, maybe your obligations aren't over with at that point in time. You may still have to do some consulting work. You may also possibly be holding some paper, so you have an interest in what's going to happen. And then with this, we talk about the concept of estate planning. We'll discuss a little bit more why that becomes critical, but if you have a large portion of your wealth tied up in your business, you're going to do a triggering event that's going to release that back into cash. What are you going to do with it? Well, in many cases, this is a good time to incorporate that into an estate plan. And then we're also going to talk a little bit about that personal plan. What is it that I should be doing after I'm done? Most people relate to one of the most recent movies out that's called The Bucket List. Well, what's in your bucket list? What are you going to go skydiving, or are you going to be, want to take the rocket and go into outer space and become an astronaut? If you have some of those hopes and dreams, they have various types of values that you have to be able to come up with, particularly cash, that would allow you to accomplish those or not. And then, do I need to have a current business valuation? And we'll talk about what you need and whether it needs to be a full certified valuation or something less than that. To understand the background for which you are contemplating the succession, you have to understand what's going on in your present environment. Right now in the business environment, this concept of exiting a business is being driven primarily by the baby boomers. Baby boomers have a large percentage of ownership interest in small businesses across America. Almost 2/3 of the businesses that are owned out there are owned by baby boomers right now. Those folks are almost all at least age 65 or encroaching on that, which then means that they're going to become retirement eligible, looking to get out of the business. So we have to look at and understand how many of them are turning 65 every year. As the stat says here, we got about 10,000 turn 65 every day. The youngest right now are 59. So over the next 5 or 6 years, they're all going to become eligible for retirement. That doesn't mean that they won't be looking to get out ahead of it, or they may stay a little bit longer, depending upon if they are prepared, if the time is right for them to succeed from the business. In 2019, 63% of the businesses were owned by baby boomers. 80 to 90% of the baby boomer wealth is tied up in their business. And 70% of them plan to transition in the next 10 years. What are the other 30% going to do? They may be holding on. They may just use it from an operating business which they are involved in to just a straight investment, meaning they will return ownership interest, shares of stock in the business. And then the other part is that of these baby boomers, about half that plan to transition, 36%, are going to get out in the next 5 years. That's going to create a logjam of transactions of people all looking to get out of business. What does this represent? It represents over a $10 trillion value for 4.5 million businesses to swap hands, go from one owner to another. That process is going to require people to be prepared. It's also going to create a very competitive environment when these businesses go to market. The part that you have to understand about the market is in any given year, 70 to 80% of the businesses that go to market never sell. Why is that? Well, we're going to talk about that a little bit. The other thing that happens is 12 months after selling, that's that 30 to 20% that actually sold, 3 out of 4 profoundly regret the transaction. The number one reason is they did not properly plan for that large amount of cash to come to them and understand what they were going to do with it. And in most cases, they wound up paying taxes that they could have either deferred or avoided if they would have utilized some of the estate planning tools that are available under the law today. 95% of my counterparts in the M&A believe the number one reason that businesses don't sell is because the sellers have too high of an expectation. They want more money than what it's worth. That's the bottom line. So it's important to understand what your business is actually valued at given the market. What's the market? The market is the buyers that are going to come in. In this M&A environment, 99% of the businesses, small businesses that sell on an asset sale basis. What does that mean? Hold on 1 second here. We have to adjust the volume. Too loud, too loud. Okay, take it down just a little bit. Okay, thank you. Hopefully we have solved the echoing problem in the communications here. We were talking about the M&A environment and about buyers and what it is that you actually sell in an asset sale basis to them. Typically, as a seller of the business, what you sell is the furniture, fixture, and equipment, maybe the inventory, and the goodwill. What you keep is you normally keep the cash, the accounts receivable, and all the liabilities. Why is that? Well, you use the cash and receivables to pay off all the debts so that you can give clear title to the furniture, fixture, and equipment, the vehicles, and the inventory, and also the goodwill. That clear title requirement is very important to a prospective buyer. So in going through and understanding that that's how the transaction is structured, then there's several key points that we'll focus on a little bit when we talk about a little bit later about the M&A transaction as one of the selling options that's available. Also, if it's a family-owned business, like a large portion of small businesses are, getting from the first to the second generation of ownership to the second to the third and the third to the fourth, you have a tremendous decline in continuation of the businesses. We get down to that fourth generation, we're only looking about 3% of the businesses survive. What does that constitute? About 1 out of 1,000 make it to that level. So that legacy at some point doesn't continue going forward. Normally, that failure has been linked by many studies to a failure to prepare properly for the transition of a family-owned business. We'll discuss that a little bit more as well. And then one of the other things that happens in the marketplace is that private companies, they're not generating the return on investment greater than the cost of capital. Okay, what the heck is cost of capital? Cost of capital is normally a combination of debt and equity. Think of it this way. We're going to buy something for $100,000. We're going to involve our bank. The bank says, all right, you have to put 20% down. So we have to put 20% down, and we have to get a loan for the other remaining 80%. Then we get the new asset, right? What we're thinking and concentrating on is, okay, when we utilize that asset in our business, we make sure we can pay the principal and interest on the loan. But we're not making sure that the return of the risk of ownership of that asset is coming to us. In other words, the equity is not getting a return on the investment. And many times that's a problem. And that's a problem that exists across almost all small businesses. All right, this concept of master planning and succession planning, basically it's a conscious effort to take that enterprise value that you have, mingle it with your personal financial value, and make sure that there is enough dollars there to take care of your next venture. If there isn't, then we call that a gap. That gap has to be assessed, and we need to determine how we can close that. Case in point, your personal wealth may be made up of mutual funds, and you have a fund manager that manages that for you. That fund manager then may have to grow those dollars over some period of time. In most next venture plans, all the money isn't necessarily needed at once. So can we calculate and estimate the timing of when that growth takes place to see if it would close the gap all the way? If it doesn't, then the other resource you have is the business. Part of the questions that we are asking to try to answer is, when's the right time to go to market? Well, one of those is when my gap has been completely closed. So I can grow my business while the financial planner is growing my personal wealth to attempt to close that gap. It's a very, very important part. Also, we're looking through this and trying to figure out if there's anything that we need to do in gift and estate tax planning. In other words, you can use the money for closing the gap if you don't have to pay it back to Uncle Sam. So it's another way to put that together. So all of that personal financial piece has to be pooled and understood so you can gain peace of mind. You want to take all of the legal, the business, the value creation, financial, and your personal issues, and you need to resolve those in an integrated plan that makes everything work. Now, I understand that it's just a plan, but we know that success, being that 1 out of 4 who does not regret selling or succeeding from their business, happens more often if you plan for it to happen. The other portion of that is this concept that building a master plan is strategic planning for the business. Obviously, because we're trying to assess our personal needs in the follow-on venture, but how much of that will come from the business? We may have to go through and look at how do we increase sales? Do we have to increase the marketing effort? Do we need some cost control plans that are put in place so that we can, in fact, increase the sales and increase the earnings so that we have the dollars available to us through either a sale or a transfer process back to us for that next venture? The other thing that happens is, what happens if something happens to me as the business owner? Or what happens if something happens to the assets that I'm using? Then we look at insurance as a continuity and a way to close that gap if something happens to them. And we'll talk about that a little bit. So, in the master plan, how do things go wrong? Well, we talk about these 5 Ds: death, disability, divorce, distress, and disagreement. Death is an obvious one. We're no longer there to be part of driving the train. A disability, something happens, case in point, a heart attack that takes me away from work. I don't die, but I'm not able, because I've got to go through a recovery health-wise before I can come and run my business. What happens in the interim? Well, do we have a contingency for that? Insurance, normally called key person insurance, is one way to do that. But what's that insurance got to cover? Well, we're going to have to hire somebody to replace me. That person's going to have some learning curve problems in their ability to operate, and there's going to be a period of time where we just flat have business loss when we find that person, especially in today's market. Very difficult to do. What happens in terms of divorce? Puts pressure on the business in most cases, particularly if it accounts for 80 to 90% of your wealth, and you're going to take a wealth of a family, and even if it's an equitable situation, divides it down the middle. All right, now who has interest and control? Well, normally part of divorce, you separate and you go your different ways. So somewhere along the way, you're going to have to figure out how will you acquire the dollars to pay for that interest so that you can continue to drive the business, assuming you stay with it, that you're not the partner being paid out. Distress happens not only internally, but externally. You could have competition that causes problems. We could have economics. We just went through COVID-19. Look at the distress that put on small businesses in America. We had disruption all over the place. We thought we were coming out of it. Next thing you know, because global disruption wasn't totally worked out yet and was still working its way through, we had additional pressures that were put on us. And then disagreements in the ownership ranks. If you have a partner and you can't get along anymore, then that can cause some problems. So we need to plan for those possible what ifs if they're applicable. If you're a sole proprietor and you don't have any partners, then disagreement is only going to be with yourself. And if you can't work that out, well, we're going to have other problems we have to work through. 11 actions that an owner must take. We're going to talk about those things. The first part, though, is this shifting your paradigm, that focus of, I'm passionate about my business, I'm working in my business every single day, and we are growing and we are making some money, but I don't have time to do this master planning because I am all in on my time and my energy and my focus on maintaining the business as it is. That shifting the paradigm that has to take place, that says, I need to allow for some time to work on it instead of just only in the business. We'll talk about why that's important. The other thing is, this paradigm should focus on aligning those 3 legs of the stool in the master plan. I need to get what my value of my business is, what my personal wealth is, and what my plan is after I succeed for the business, and begin to integrate those and get them fully resourced so I can accomplish them. And then the other part is, I need to be focused on business value, and that's different than focused on profit. The transferable value of a business is where you make the money in a sales transaction. We talked about that. In an asset sale, furniture, fixture, and equipment, goodwill, inventory possibly, is what you provide to the buyer. Well, what are those things worth? Well, okay, where do we get that from? Typically, we look historically at the operations of the business to understand its sales and its earnings. The earnings aren't necessarily all encompassing from a buyer's perspective. He needs to look and understand what they are as a base, and then has whatever the future. Is the industry growing? Is the industry stagnant? Or is the industry declining? What about the economy? Is the economy going up? Is the economy topped out? Or is it declining? So all of those aspects affect that going to market and how much I can expect to get out of my business. We've got to understand that relationship and see that's part of this paradigm shift and aligning the three legs of the stool along with getting it in sync with the market and making all that happen. Difficult thing to do. The concepts that we operate here are the concepts of focusing on the present. Okay? Can't worry a whole lot about what COVID did to you. COVID was disruptive to everybody. So everybody has disruption. They were varying degrees. I get that. The recovery process is what you need to be focused on, because you're looking to get that 3 to 5 year good history to take to a buyer to optimize the return on your investment for your business if that's where you're going. And when we talk about buyer, that could be internally to a partner. That could be to a replacement shareholder for yourself. That could be to your employees. That could be to a management buyout. Your key managers could buy you out. It could also be a transaction between you and one of your loved ones, parent to child. But we can't just gift it to them, because in our plan for what we're going to do next, we need a certain amount of money to be contributed from the business. And at the same time, we want to make sure that the legacy is going to continue. The last thing you want to do is sell something to somebody and it fails immediately. Chances are that that may get revisited, either through a court system, or if family, you may be pulling it back and taking back the ownership yourself and trying to restructure it. So it's important that we understand also a concept called transferability. It's easy to figure out, okay, I got to transfer the assets. Well, the assets have to work and operate, right? They have to be physically present. I need to have clear title to them so I could transfer them, meaning I paid all the debt. Nobody has a claim against them. Ultimately, though, what do we do about this concept of goodwill? Where's it come from? Well, technically, you have a sales price and you have a cost allocation for furniture, fixture, and equipment. You got a cost allocation for inventory. And then what's left over is what gets allocated to the goodwill. And that's typical in a small business transaction. Well, how big can that be? Well, that normally is based upon affordability. We need to understand that in the affordability model, there are a minimum of 5 main concepts that the past earnings with a future growth forecast, if that's what the market has for your industry and for the economy aligned going forward, that it would be able to pay the owner a salary at market, or the ability to hire a manager to run it. A general manager coming in would have to be the dollars available to cover the costs that you could, in fact, find that person and bring them in, motivate them to work in that position. The second thing is, Well, what's the business going to cost? The principal and interest payments on the purchase. That has to be covered. We said that you get to keep the cash. Well, then, if you took all the money out of the checking account, there's no working capital in the business. Well, that has to be covered. If there are assets, but they need to be replaced in the near term, maybe they don't need to be replaced in year one, but maybe in year 3, 4, 5, whatever the term of the debt, the repayment of the debt, the principal and interest, anywhere in there, we need to make sure that we have those assets available. The money's got to be generated out of the business to cover that. And then the last piece is the return on the down payment, the money that you put in when you made the purchase as the buyer. Those dollars need to have a rate of return. The rate of return can range in value. That value range on a profitable small business could be somewhere in an 18 to a 28% range every year. What's that normally say? Well, if 25% is the average, that means that you should expect in 4 years to get all of the money back that you had put down in a down payment. Small businesses are considered risk. That's above what you can expect to get out of the marketplace. Yes, because that marketplace, made up of minority interests for the most part, spread the risk across many shareholders. In small business, that risk tends to go the opposite direction. It may only come out of one person's pocket as the business owner. So you have to recognize you bear that whole brunt of the risk. So how do we get this done? Well, we need to be looking at this present time frame. Most people would say 90 days in the future. And then we need to have a plan that we're going to look at every 90 days, and we're going to build into it the accountability. So if there are things we need to improve, maybe we've got to increase the sales. And at the same time, we have to get the profits up, because the lag that we have, we've got some sales and we can create more sales, but we can't get the earnings to grow at the same rate. Well, then we're creating this lost leader concept that really isn't going to improve the value of the business. We won't be closing the value gap that we need to afford our plan. So we need to be conscious of not just the sales side, but we've got to be conscious of the earnings side. So you're going to integrate a marketing plan and a cost control plan to make sure both of those come together. In this process, we use this concept of value acceleration. At any given time, in any given industry, you'll find that in that particular industry, there is a range of values that businesses trade at, or when the transaction to sell takes place. What is that? Well, what do I mean by that? In most cases, we normally will get some indication, a multiplier associated with sales and a multiplier associated with earnings. If we're looking at sales, that range in an industry could be in the 30 to 60%. What does that mean? Well, for every dollar in sales, when we sell, we're going to get anywhere between 30 cents and 60 cents on that dollar. So if we have $1 million in our sales, we're either going to sell for $300,000 or $600,000 or somewhere in between. At the same time, though, that value of our ability to go to market and our ability to sell has to be supported with the earnings. Earnings have a different multiplier associated with them, because sales is all the dollars you bring in, and the earnings tend to be after you paid everything out, right? That's where that comes from. So if that's the case, then that multiplier could be anywhere from $2.50 to $3.50 in a particular industry of the earnings. Again, what does that mean? Well, if you have $100,000 in your earnings, and it's 2.5 times that, it's going to sell for $250,000. 3.5 times, it would be 350. But we said the sales range on a sales portion was between 300,000 and 600,000. Well, now we've just tightened that group. Somewhere between 300 and 350 might be the most likely area that you might trade or a transaction might be done. Again, because aligning the sales and aligning the earnings to make it successful. What happens if the sales floor is here and the earnings ceiling is below it? Chances of a sale don't happen. Why? Because the earnings can't afford it going forward. This is why that 70–80% of the businesses on the market don't sell. They fail to account for, in a buyer perspective, the dollars that they need to have in earnings. And many times in small businesses, we struggle with this concept of, okay, I have a lifestyle investment, or I have an optimize and maximize my return on investment concept. Both of them have to pay taxes, but you might have more discretionary or lifestyle expenses that then aren't available to the earnings on the bottom line. If that's the case, then we may have to shift that paradigm or that concept from lifestyle to maximizing the return on investment, because we need to get the earnings to overlap the sales value so that we're able to get to a point where we can get a transaction. And again, it doesn't matter how we're going to get that transaction. The other thing that's most important that you have to keep in mind on this focus of the value acceleration is it only works if you look at it on a regular basis, okay? The frequency that you review this has to be there, because it's easy to get back into only working in the business rather than strategically attempting to drive the business to a particular value effort that you need to have to accomplish your master plan. And then when we put together our people as one of those main things we transfer, we have to build a reliable team. That team has to be able to accomplish the business on a regular, profitable basis going forward. So it's important, one, that they stick around, two, that they know how the operation works, and three, that they are somehow motivated to sustain it into the future. Because isn't that what the buyer is going to want, and why they would be willing to pay for the goodwill, is to get that in their business. And then the other thing is that you have to make some decisions about how much time am I going to allow, and am I going to have to put more of my capital, my personal money, into this business to get there so I can make this happen. Those should all be reasoned judgments. In other words, an expected outcome is anticipated, meaning you plan to get X. And then you look at where you're at and what that difference is, and how many dollars do I have to put in, and at what intervals do I have to put them in to get there. And if that makes logical sense to you, you do the investment. If not, then we have to come up with a different way to solve the problem. Okay. The other part that we tie in with this is this value maturity index. What are we talking about? We're talking about taking the personal wealth and we're talking about the business wealth. And we're going to integrate them by going through a process that says, first we have to identify the different classes of asset that we have. Okay. Well, we had mentioned about having mutual funds, right? That's on the personal side. But then we also said furniture, fixture, and equipment, inventory, vehicles, and goodwill were going to be on the business side. So those are all the assets, and they get identified. Then what are we going to have to do with that? Well, first of all, we need to protect them. And this is a broad definition. I'm not talking about just insurance here. I'm talking about the ability to go ahead and take those assets and make sure that they're operating how they're supposed to. So that mean I got some kind of maintenance plan associated with it? Could be. Um, does that mean that I've trained my people and they are proficient in operating them? Definitely. Because your processes that you operate to take care of the products and services that you deliver are very critical in your ability to create sales, and how efficiently you do that is how you create the earnings associated to those sales. And then ultimately, once you've gone through and you've got them protected and you're building them, now we have to get ready to harvest. What does that mean? Well, that means that before we may have been operating in this lifestyle management, we're shifting over here to our maximizing our return on investment. And with that concept, we're then going to have the ability to maybe do distributions or internally to create additional cash to increase the working capital so that we can maybe scale up on an accelerated basis the growth of sales and the earnings of profits. Once we're able to do that and get control of the business, now we have to sustain it. Why? Well, we talked about this concept of triggering event. And we said, look, we got to see, is our industry going up? Is our industry stagnant? Is it going down? Is the economy starting up? Has it topped out? Or is it going down? Simple case in point. If you would have borrowed money 3 years ago, you'd have paid somewhere in the 3%. If you borrow money today, you're going to be paying in the 6 to 7% range. Well, what does that say? Well, it says that the cost of money on the debt side has doubled. Well, then it means that our ability for a buyer to borrow, he can't pay the same amount. He's got to pay a little bit less. Oh, yeah, okay, but I need a value to close my gap. So I need to manage the sustaining level until the timing is right, or that I have grown sufficiently that the earnings are there that I can close the gap under the present economic conditions. Okay? So it's very, very important in working all that through. So this concept of value acceleration methodology, you have a benchmark. You know by going through and doing a business valuation. So that answers the question. Do you need one? Yes. Because we need to know where are we at today? And what is it in today's environment that we would get dollar-wise for our business? Typically that is done with a benchmark analysis versus a certified appraisal. Certified appraisal is a lot more expensive. The benchmark only needs to be for your management use. It's not something that we're going to be paying taxes off of. We're not going to go to court over and utilize that report for that purpose. What we're going to do is use it for our strategic planning needs. That's the intent. Then once we've gone through and done that, we need to understand value drivers, things that bring people to us for our products and services. What are they? And at the same time, we need to understand what value killers are. Right now, if you're in the single-family residential construction business, one of the value killers is this increase in the interest rate caused by inflation. So inflation is a value killer for you because you're not able to sell as many homes as you may have wanted to in the past. So what we want to focus on is where do we have the opportunity to grow, okay? And that growth is not just sales, but we got to grow the earnings at the same time. And we have to make sure that the earnings and the sales within the metrics that get developed in the benchmark are being utilized in this value acceleration methodology. So that if you have a business that has a sales metric of 0.4, 40 cents on a dollar. And all of a sudden, you've been operating at $1 million and you just got a brand new contract. That brand new contract was for $500,000, $500,000. Wow. Okay. What does that mean to my value? What did I just do? Well, I was operating at $1 million and I got 40%, okay, 400,000. But I just went to $1.5 million. Oh, all of a sudden I'm worth 600,000. That's under the assumption that also the earnings were there. If that earnings multiply would support that, then yes, you've accomplished that. So that's what the value acceleration methodology does. It focuses on value, not sales by themselves, not profit by themselves, but their impact on the value growth of an expected transaction sometime in the future. When we put these action plans in place, we should then be able to see what we're doing in terms of the value gap, if we have such a thing. The other thing is that we have to look at this on a regular, repeat basis. We go back to the publicly traded companies and we copy what the heck they're doing. Under the UCC rules, okay, they are required every 90 days to issue quarterly reports for publicly traded companies. In those quarterly reports, they do a complete review of where they were over the last 90 days, where they expect to be in detail in the next 90 days, and then they look out a year, 2, 3, 4, 5 years, and sometimes longer. And they provide information back. Well, we need to be looking at this in a very similar manner, because if you look at the statistics of what we were talking about, longevity, of going from one generation to the next, or from one small business being able to successfully sell and exit the business, those stats don't look too good. There are more businesses that close and go away than those that actually continue and sustain. And what we want to do is be part of that growth group that continues on, because that value was transferable. That's what caused that to happen. We also need to look at the type of tools that we build inside our team, and we need to understand that the owner of that is still the center. But now he's not working in it directing traffic, but he's working with his advisors and his key management folks to work on it, to get from where it is now in the initial assessment to where he needs it to be. Okay. Exit planning strategies. Okay. We have to understand about, first part of this is, how do you see it happening? What's your vision for it? Because if your vision is that you're looking for family members to come on board and to try it out and like the business and actually be the legacy, that's a good thing. I personally know that I have 3 children. All 3 of my children, when they were in college, they all worked for dad. But each one of them made it very clear as they got close to graduation, Dad, thanks, but no thanks. I'm not interested. I don't want to do what you do. I want to do what I studied in school. And that's fine. You know, I'm glad that they're healthy adults able to make up their own mind and go after it. That's great. That means more so from my wife than me, I think, that they had great parenting. That parenting helped them become solid, functioning adults. But at the same time, I don't have a legacy inside my family to transfer it over. So I have to come up with a different option. What do we do with this concept of when do I think I should get out of the business? Well, first and foremost, hopefully we're in good health and we can continue to do what we love doing. That is working in and working on the business. If that's the case, then we should be able to determine when we want to get out. We can pick an arbitrary date. We can also look at our age and say, well, look, I only want to do this for X number of years, and then I want to start into that next venture, my retirement plan maybe, okay? And I want to get into that. There are things that I want to do. All of that has to be considered in developing the exit. And then what changes do I have to make before I can exit? Well, let's go back to my example about my children. Let's say that one of them decided they wanted to stay and that, yep, they wanted to do that. Well, what all do they need to have experiences in? They're in working in the business and dad's still the traffic cop directing everything and making sure everything gets done. I need to make sure that I'm training them in all aspects of the business and preparing them to replace me. Part of that is that at some point I got to struggle with the release of control, right? It's not an easy thing, but I'm going to have to work through that. They are going to struggle with acceptance of control. They may sound like they want it, but be careful about that gift horse that you ask for, because if you ultimately get it, you may find the burdens that come along with it. Simple things like, yeah, I want to sign all the checks. Okay, then you got to make sure that they're good and that the money's in the bank so that your checks don't bounce. So all of those things are part of that process that has to be reviewed and assessed to determine when would I be able to get out. I can't get out until the pieces that are going to replace me are ready. Okay? Because if I leave sooner, and if I don't get all my cash at the point in time when I leave, if there's any second bite of the apple opportunity or any kind of principal and interest that I might be holding on a debt instrument, it may not materialize. That could jeopardize my ability to accomplish whatever I'm planning to do next. So, where do you begin? It makes sense that you should talk to advisors, professionals that are in the business that understand how this works. The key part about professionals, no one person has all the answers. This is a collaborative process. We're focusing on the business operations, we're focusing on your personal wealth, and we're focusing on your estate and what you're going to do after you depart. All very complex subjects, and we're attempting to integrate them into one master plan. There's no way that anybody out there can tell you, oh, I know how to do all that. Don't worry about it. You don't need anybody else. Just listen to me. That's not true. It's just not there. It will require a collaborative effort. So what does that mean? Typically, in a collaborative effort, we have the owner, we've got their management team from the business, we've got their family team that's associated with the planning process on the personal side, and then we might have some advisors that are going to be focusing on gift and estate and taxation issues. Within all of those groups, everybody has specialized areas that they operate in. How will we actually get this to happen? It happens in collaboration. That's how it happens. You can't have any one of those advisors saying, I don't care what Bill said. Forget that. We need to do it my way or I'm leaving. Well, if that's the case, the value of your plan is going to have the risk of the one person's experience and abilities. I think you're better off with a blended experience and abilities, that skill base coming together. Does that mean that, okay, everybody has to be co-equal? Probably won't work that way. Somebody will have to be your quarterback. And if you're busy working in the business and on the business, then you most likely shouldn't be the quarterback that's going to put this. You will review and you will observe all of the playbooks that get developed, and you will ultimately finally approve those. You have to do that. Can't take that burden off of you, okay? But in that circumstance, then you should be able to put this together. You're going to have to read up on different subjects. We just covered a whole wide area. You've been working in this business with your passion and trying to work inside it to get it to go for years, maybe. Some of us have been at this for a couple of decades. And if that's the case, what do we need or know about the personal financial end? What do we need or know about that taxation, gift, and estate? Areas that we may have not spent a lot of time in. So we're going to have to take whatever little free time we have and bone up, start to read and understand. The other thing that's important is that most of these are in fact done as transactions. Conventional wisdom says it doesn't make sense for you to have a legacy in a family-owned business from parent to child, or from one brother to another sibling, or from one sister to another sibling, and transfer the business in that fashion where it's a gift. Why is that? Well, in the gift concept, there's no skin in the game by the receiver of the gift. You assume that that passion's there. Nothing makes that passion have to happen other than they have to earn it. And that's been true over time, proven time and time again. So conventional wisdom says, yes, you can gift some portion, but the majority of it needs to be earned. That controlling element of an interest in a business needs to be earned. What does that mean? They have to pay for it. They have to pay you for it, more importantly. And so then the question is, how much? Well, it should be at market. What happens if you sell it and you sell it at a discounted price, and a year later, they need to get out because, good news, they won the lottery. They got a $100 million ticket and boom, why should they be in the business anymore? Well, what's that going to be worth? Well, wait a minute, we had a discounted transaction a year ago that even though we should have been selling between $400,000 and $600,000, they sold it for $25,000. Oh, wait a minute, that's on the record, right? Yeah. Oh, so what do you think a buyer is going to think about when they look at that? You're going to affect their perception of the worth that this business has. And so it's important to understand when you do that, that you're doing it for good reasons and that you are able to ensure the legacy will continue forward. All right. The other thing is talking to a business broker or talking to an investment banker. What's the difference? Well, I'm a business broker. I'm an M&A guy. I work with small businesses. If I was an investment banker, I would be resourcing businesses that are attempting to go public. If you're large enough and your size would warrant, then yes, that's who you need to be talking about in your succession plan, is with an investment banker. If not, then you should be, one of the advisors should be that business broker, because more than likely you will need that business transaction skill in however you solve your succession plan, whatever option you elect in the end. Okay, what are my transfer options? We had talked about the generational transfer, parent to child. We have management buyout. You have key managers, they pull together their resources and they come in and make a buyout over time. We are seeing in small businesses 100% employee stock option plans, where all of a sudden the employees own all of the business. In reality, though, the majority of options that are out there are some combination of a management buyout and an ESOP plan. It's doable, and it can be put together. You can also sell your interest to maybe one of your partners if you have them. You can sell it to a third party, or you could be acquired through a typical merger process, okay, or an outright acquisition by another company, where they come in and buy the assets, and it's normally still done on an asset sale basis, not on a stock sale basis, and operate the business. You can go through a bank debt structure. If the business has assets and it has earning power to pay back the debt, you go borrow money with the intent that that borrowed money is going to go to you to help you close that value gap so that you can execute your plans. But know in today's environment that more than likely the assets will be pledged, and since you are one of those owners or the owner of the business, they're probably going to want a personal guarantee. So yes, I got the cash, but I'm still kind of on the hook. So I got to be careful as to when I start to use that money to take care of my next venture. And then there's the opportunity that it can go to a third-party management. Happens in certain industries. Common one is hotels. If you own a hotel as a business, you have hotel management companies. You also have restaurant management companies that come in and operate the facility for you. You have to pay them a fee, but you're not there doing the day-to-day work. They take care of that. And then there's this other option. I operated a business and I was maximizing my return on investment all along. I don't have a whole bunch of lifestyle investments, and I was able to fund myself through the dividend distribution that I made, and my personal financial wealth is such that it can fully fund my next venture. Well, then we can do a liquidation. We got no problem. Typically, what we call a lights out. Come in, sell everything off, and poof, go away. The key there is you got to understand when you're planning your exit how you want to make it happen. Liquidation, in some cases, because you have this concept of forced liquidation that's out there, a bank loan goes bad and the bank has to come in and do bad things to people and puts them out of business and sells their assets. Well, liquidation has this other thing, okay, that is called orderly liquidation. And that's what I'm referring to, the orderly liquidation process. And that is, again, based upon the fact that you are able to take whatever value you get, call it an auction, you could sell it to a competitor, it doesn't matter, you're just selling it to take all of the responsibility of operating the business off your shoulders. You're free. Now you can go and do that other plan because over time you pay back yourself and you have the investments to afford what you're going to do throughout the rest of your life. So those are the options that we have available. So in strategic planning, there's a couple of key factors that you have to take a look at. First, what's my objective? What do I want to accomplish? And when do I want to accomplish it? Who are the key employees that will continue working in the business, the operational process? Who are those key employees that will take care of the financial decisions? And then who are the key employees that will oversee the internal administration, hiring and firing people, making sure that the lights operate as they're supposed to? Who are the types of advisors? An attorney, an accountant, a financial advisor, an insurance professional, a tax advisor, and in this case, if you're a small business, we put a business broker in there. Those are the main ones. Can I have more? Yes, you can. Yes, you can. Again, it depends upon what you're looking to accomplish and by when. All right, we're going to take a brief break here for an intermission, but before we do that, probably be about 2-3 minutes, I want to offer you the opportunity to send me an email. You have my email address up on the screen. And what we will do is we will enroll you in the first 8 chapters of Walking to Destiny. Scott Snyder is the author of Walking to Destiny. He is also the owner of the Exit Planning Institute. It's his concepts that we're making this presentation about. He is the guy that came up with this value acceleration methodology. And what we want to do is provide you the opportunity to read through in more detail and expand your comprehension of the items that we identified on the briefing charts, not only in the first half, but in the second half of the presentation. So if you would, just take a minute, shoot me an email. We'll get you enrolled in that program, and we'll get those out to you. If not Friday, get them to you on Monday. All right, let's take a 2-minute break. Thank you. Okay. All right. So that was a brief intermission. Hopefully you had a chance to forward an email to us, and we'll get you enrolled in a program that'll begin to collect information about succession planning. Who are the other individuals that should be part of this? Most of the people that we talked about, you would think would be involved in the business operations side and maybe in the gift, estate, and tax. We need to also integrate family and friends because they will be part of that personal plan that you're going to develop for the next venture. And they're more than likely also involved in your own personal wealth, separate from the wealth of the business. And in that, there could be other outside life coaches and things of that nature that you want to incorporate. We also have spiritual coaches sometimes that are involved in the process. All of that depends upon the individual and what you would like to have brought in at that point in time. So the contingencies have to be put together for those 5 Ds. So who do you have to talk to and who you shouldn't talk to is something that you would know. The point is you have a legacy, and that legacy, for it to flourish after we're no longer involved, you need to provide guidance to people that are there. So if the 5 Ds do creep in and you are taken out, you got to define who they should or who they shouldn't talk to. You also need to explain to them, in your absence, what do you want to have happen? Okay, if you've got plans in place for your marketing plan and for your cost control, and you're working towards the value acceleration methodology, then how do they understand where that information is? You need to collect that in a way, and it needs to be maintained so that they could quickly read up and they would then understand what your wishes are. Very important part of that. The other part is you've made all the decisions along the way in the business. You need to make the decisions on how you go to exit as well. You can't skirt that. Otherwise, you're going to predestine the outcome. It's not liquidation on an orderly basis that you may be creating. It could be liquidation on a forced liquidation basis. Nobody wants that kind of legacy. When's the right time to go? Well, good health, got good market conditions. I got a great economy going on, and I just got this offer that I didn't solicit, and it offered me more money than I had in my value acceleration methodology process. I just have to figure out how I can get them to agree to pay that to me. Okay? Will you be prepared for the unsolicited offer? Do they happen? Yes, they certainly do. So that right time is before death and before disability, obviously. You want to make sure that you are just winning a contract or just losing a major client. If that happens, is that the time to go? In most cases, maybe not, but it depends. If that client was a large sale but had the smallest profit margin, so that you were getting high sales but you were having trouble getting the earnings up, losing that contract might not be as bad as you think, especially when you're now focused not on sales and profits, but on value. So you need to be prepared to capitalize on the opportunities as they materialize. What happens when that major customer goes away? Well, we need to think about it, and we need to adjust maybe our plans. We may need to adjust our timelines. We may have to go back and what we plan in that next venture, that may have to get adjusted too. Because after all, we have to be realistic with ourselves, right? And what can be accomplished. We need to also understand what happens if one of our partners are no longer able to work in the business. What does that do to us? How do we continue? So we need to have contingencies in place, not just for something bad happening to us, but for those key individuals around us. If the children have an interest in the business, what are you going to do to develop them and make sure they have the ability to earn the business into the next legacy of ownership? We need to also understand that bad things do happen to good people. And that's this concept of what happens if, the C word, the disease called cancer, if something like that happens. It has this ability to cripple us for a while we cope with what the heck that all means. Hopefully, in the near future, we're going to get better at how we handle this. And if that's the case, then we should be able to make progress even when we've gotten some kind of medically bad news. All right, how do I ensure my people stay? Well, there's a couple of different ways. Sometimes it's done with present day ownership. It could be also done with some of the proceeds if in fact you actually sell the business and move on to the next venture. So what do we mean about having this loyalty that they're going to stay through the transition? Well, that could be accomplished through what we call a stock appreciation opportunity is one. There could be bonuses, which is another one, that could be out there and could be offered to the individuals. We could create a profit sharing plan as well. Multiple options that we have that try to accomplish the same thing. But in this idea, understand that it's a short-term motivator, the money that's there, okay? Because in a stock appreciation plan, the voting rights normally are not in there, so they don't actually have control over the changes that take place inside the corporation. What they can do, though, is receive dividends or distributions. So if money is made and the decision is made to distribute that, then they have the rights just like any other shareholder. There's some other issues associated with that. That ownership is normally linked to employment. What's that mean? That means that if in fact they quit and go somewhere else, that those shares have to be bought back. And they're going to get the value of that, but they're no longer having an ownership interest and they're no longer an employee of the company. We can also have buy-sell agreements. Got partners in the business or other fellow shareholders. If one person wants to get out, how do they do that? can they do that? Can they sell that internally to the shareholders themselves, which is typical? Can they sell that back to the corporation, which is also typical? What doesn't happen often is their ability to outright sell them to third parties. Normally there are buy-sell agreements that restrict that, restricted stock rights associated with it. So we can use those agreements for that purpose to maintain that close control of the business. Additionally, providing that continuity bonus is a concept that says, I got paid $1 million for my business. And what I've got 3 key managers, and if they all agree to stay for the next 6 months, I'm going to give each of them $5,000. If they stay for an entire year, at the end of that 1-year period, I'm going to give them another $10,000. And if they stay for the whole second year, at the end of that period, I'm going to give them 20. That's 35 times 3. I just sold this for $1 million. I tied up 100,000 to make the deal work at that dollar value, okay? And I only needed 900,000 in my plan to close my value gap to do my next venture. It's a win-win. It works, and it makes your business attractive to a buyer to be willing to pay that, because he knows that he's got proper motivation to keep those people on board. Can we go ahead and fund bonuses out of dollars? What do we do? Well, if they are money that has to be paid out in the future, we could put it into an investment that's going to also grow before that payment has to happen. So it's not necessarily dollar for dollar in our proceeds that have to be set aside. And then how do you go through and also ensure that you can hire a replacement for yourself, especially if that happens throughout this transfer process? If the business is going to continue and you're going to stay in, but you're not going to have 100% control, you're going to go back and have a minority control and sell it off to somebody. That's one way to do it. It's a possibility. So you have to work through those options and figure out what's best for you, and keeping in mind, we're focused on that value acceleration and what we need to close any kind of value gap that we might have. Whose advice? Again, we've talked about this before. No one person has all the answers. Should you also be talking to fellow business owners? I would talk to anybody that successfully transferred the business, and you know that they've done that. What did they like about the process? What did, lessons learned? What would they never do again? What were those things that gave them the greatest joy? And what were those things that were the oh crap kind of thing? So, because this is highly complex, the collaborative team approach is the best business practice. There is no other way around that. All of these people need to be sought after and pulled together. Now, you hire all these people. These all cost, over $100 an hour maybe, or more. Well, yeah, that's true. This is not cheap. You got to understand that. So it's important that you come up with a game plan so that you understand, if I have more time, can the business pay for these types of services that I might need to get ready to execute that strategic planning process? And the answer is yes. Time is our best friend under those circumstances. Remembering that succession planning is working on your business, not in it. It's that piece that's looking at, how did I do in the last 90 days? What do I got in front of me in the next 90 days? And peering out and seeing what's coming in a year or two that's going to allow me to get to my triggering event so I can ultimately execute the succession from the business. And then understanding how to add value to your business is critical. We talked about the need for the benchmark to give you those metrics so that you can understand how you drive value up. not just sales, but sales and earnings that equate inside the metrics that are attributable to where your industry is trading. You'll find that business brokers like myself, we have that information. We can help that and provide that to you, so you would better understand that your industry is trading within this range and you fit right here. That's what a benchmark does. And more importantly, if you grow sales by X and you grow earnings by X, you're going to increase your value by so much. And that's critical information that's strategic in nature, that says, okay, under those circumstances, I can make investment decisions to put money in my business or to leave money in my business, to grow my working capital, to pay for capital expenditures so that I can get to where I need to be and the value enhancements that I can make. The key here, though, is each business is unique. There's no way around that. You can look at 5 restaurants and they would maybe all come up with 5 different options on how they want to depart their business. They may come up with different timing that they want to depart their business. They also may come up with a concept of what it is that they're looking to make happen, where they're never going to leave the business, only get out of the day-to-day operations and remain as a owner of some sort, whether it's a controlling interest or a minority interest. The concept of succession planning is to preserve wealth. Number one is to get the value acceleration and optimize that return on investment. In that is a tax strategy that says, okay, I have also deferred or avoided taxes on what I've done to grow my business, and understanding that I have certain taxes that I have to pay. Income is a normal one, but we also have this capital gains that exists right now. You know, if the asset is sold and you have a gain on that sale, you're taxed at around 21%. So, you know, yeah, I may be, as a collective individual, have other deductions or expenses that I can put against that and work to minimize that. That's the area where we need somebody that understands your personal tax situation and has good skills, normally your accountant or maybe a tax attorney, that can help you not only with the growth, but also with the retention of the dollars that you are working to pull together. So consulting with an accountant and a tax advisor is very important in this process. Are we organized right? Do I need to be in a corporation of some sort, S Corp versus C Corp, or should I have a limited liability company? And all of those aspects have to be considered to figure out what type of exit strategy am I trying to make. If I want to have a stock appreciation plan for my people, then I better have stock. I can't do that as a sole proprietor. Okay, I need to have those interests available to them so that I can work that through. So again, depending upon some of the tools that seem attractive that might help you motivate key management people to stay along, you need to see if you're in position to be able to take advantage of that. Again, consulting with an attorney, an accountant, or a tax advisor is important to understand that. And then what's the best form of organization? Well, again, it's up to the individual and how they see that exit process taking place. If we need certain tools to make that work, then we need to be organized to allow for those tools to operate. So the structure can, in fact, make it easier to get a sale accomplished down the road. We want to sell to employees under an employee stock option plan. Well, we got to be incorporated then. We can't do that, okay, as a sole proprietor or a partnership. So we have to work through that. Developing an estate plan. You have to remember, if you're like most business owners and you've got 80 to 90% of your wealth tied up in that business, when you go to exit and that liquidity all comes to you in that triggering event, what are you going to do with it? Well, you better have a plan. If you don't have a plan, what you're going to be doing is taking a portion of it and writing it straight to Uncle Sam. So you need to develop an estate plan. It says, well, wait a minute, Bill, you're confusing a taxation plan with estate plan. No, they're integrated within one another. Okay, we're looking at that from that perspective. That they are integrated, and they have to be to figure out what you're going to do. The development of the estate plan also provides for those contingencies that say, all right, I'm getting ready to come out of this business and I'm going to retire, and I need that event to take place. And in there, I was also in my estate plan, I wanted to fund something for my grandkids, college funds. Okay, common thing a lot of business owners look at. But if something happens to me along the way, and I've got this set up and I'm ready to execute it, but I can't get the dollars out of the business because I either died or had disability that impeded me on that, what am I going to do to make that work? My family is probably counting on that materializing. I was counting on that. If I have a disability and I survive, my mental outlook is going to be affected by my ability to accomplish that. So if I can make that happen, then I should. We also want to make sure that we're not one of those businesses that gets sold at a fire sale. It happens far too often. Somebody comes in and says, "Oh man, this is a good deal, man. We're selling this business for less than what the bare assets are. The cost of opening up across the street and competing." We need to make sure that we're going to have the dollars in there so that we're operating the business and avoiding that situation. Some of the things to keep in mind in this estate gift tax skip generation taxation. Right now, in this current year, 2023, you can give an annual gift of $17,000 per individual. So I could give to 5 different individuals up to $17,000 in this year, and I make note of that, but it doesn't go against my annual my tax exclusion or tax exemptions that I have available. As an individual, I got $12,920,000. That's a lot of wealth to accumulate. If I take my spouse and we pool ours together, we have over $25,840,000. The kicker is this is good right now on the law until December 31st, 2025. At that midnight, on stroke of midnight, December 31st, 2025, the law reverts back and those numbers come way down in the $5 and $6 million range. So we have to develop this personal plan. It's best if it's put in writing where we can express our personal objectives, and we know that if we put it in writing, chances are much greater, about 70%, that what we put in writing will actually work to make happen. And because it's in writing, if something happens to us temporarily, others can read it and figure out what we want done. So where do you begin? Do I have to get a benchmark? Yes. Otherwise, what's it worth? What do you have? You need to understand what that market will generate if you were to take the business and do a transaction today. Based upon that, does that value then meet your personal needs? Meaning your personal wealth plus that business transaction, the dollars you bring together, will they cover the plan that you expect to have, the 3 legs of the stool going forward? Do we need to have a certified valuation? No, it's not necessary. We're not in the gift and estate tax filing business. If we were, then yes, you'd have to have a certified valuation. Getting a benchmark is necessary for the gift and estate tax, but an impartial third party can assist you with determining the value, coming up with those metrics. People that provide certified valuations can also do uncertified, which is what we do here at Keystone. There is also a an opportunity in small business that doesn't happen much. You can increase the likelihood of a sale substantially by having audited financials, not reviewed, not compiled, okay, but audited. Most don't do that. When you get that unsolicited offer from a big company somewhere, they're going to come in. More than likely, you're going to find that they're only going to buy after the audit, and they're going to make that happen. Now, they may pay for it, but if you had audited financial statements up front, the price that you're commanding under an audited value stands up and holds because a third party said these numbers are correct and they're reliable. Okay? So it's not something that, well, I don't think that's going to be that high of a value. No, it was reviewed through an audit process and it's certified that it's X. You'll find that buyers will place a high reliability and credibility on audited financial statements. Typically, they like to see 3 to 5 years. They want to see financial statements. What's that mean? Typically, that's a profit and loss statement. That's also a balance sheet, and it's a cash flow statement at a minimum. Sometimes we get a retained earnings statement requirement as well. So you start with the several years before you intend to sell, and you make sure that those financials that you're working on demonstrate that return on investment opportunity. Should I keep a file? Yes, I should. I should have in there anything related to business succession instructions. Who to sell to, who to talk to, who not to talk to, who not to sell to, what kind of value estimate I think I should be getting for that. I should also have a file for my estate planning. I need to have my personal plan in there, and I need to identify who the exit team is and what instructions I've left for them if something has to happen and I'm not there to see it through. So articles of interest, we just gave you that at the intermission time, asked you to send us in an email, and we will send those articles out to you so that you can start to read that. Contact information on anyone who has expressed an interest in your business, having a name, a telephone number, or an email address kind of thing would be good for someone that's coming in and trying to figure out what to do with the business. Having a list of good prospects. This is the seller's mind. You, the seller, thinking these would be good buyers for my business. Who are they? Could help the people that have to come back in and take a look at how they were, in the event that you're not there, how they would transfer the business. Okay, so we've gone through and talked about a lot of different things. I think we've answered where do you begin. You started that tonight if you haven't done so before. What are your transfer options? We covered all of those. Talked about going to family with the generational transfer. We talked about management. We talked about partners. We talked about the ability to go to employees. We talked about having the option to sell to third parties so that you have all of that out there. We discussed the key essential advisors that you should consult. We also talked about other individuals, the families and friends, but also maybe the life coaches and people of that sort. When's the right time? The right time depends on many things, and so you have to look at that. But if you remember the value maturity index that we talked about, is you have to get up to the harvest level and sustain it through a management level so that you're there every year in, year out until you get to the point and say, I'm ready. That talks about when the right time happens. Then along the way, we got to have the what if analysis to make sure the 5 Ds are covered. We also talked a little bit about our ability to motivate employees to help us shore up any kind of knowledge gap in the operation of the business. And we talked about best business practices that you should incorporate into this succession planning process. We're trying to drive home the point that wealth estate plans are part of this master plan. They have to be. And because you've got this sudden liquidity that comes at you, you've got to know what you're going to do with it. You got to know the answers. And then, do you need to develop a personal plan? Yes. Without that, you're going to be that 3 out of 4 that profoundly regretted doing the transaction, even though they were part of the 20 to 30 that were successful in selling their business. And do we need a business valuation? We need a non-certified valuation. I think that that's important for the value acceleration methodology to work and operate properly. Okay, that's our presentation for this evening. I hope that we have at least began to orient you in the right direction about this concept of master plan and how we have to look at how you would succeed from your business. The time is never too early to start this process. It's also possible that some of you that are out there saying, I don't have a whole lot of time here, Bill. I really just need to go through the process of the M&A and I need to get out. We can help you with that as well. Just let us know. You can send me that email and express that. But right now, the focus here this evening is to talk about that building that master plan, the strategic process of working on the business and not in it. Again, I thank you for joining us. If you've got any questions, please give us a call or drop us an email. Thank you. Have a good evening. Bye-bye.